Hello everyone and welcome back to these sessions on Advanced Strategic Financial Management. Friends, in this class we are continuing with the topic Advanced Capital Budgeting Part 1, and in today's class let's discuss concept of adjusted present value. So you know what is net present value and how is net present value determined. Our focus point right now is what is the meaning of adjusted present value and how is that determined. Before I discuss what is adjusted present value, let me first talk about one thing: impact of financial leverage on investment decision, because that is the base of concept of adjusted present value. I repeat, we should first understand impact of financial leverage on investment decisions. Now, you know what is leverage. Leverage is a term where an entity is utilizing somebody else's resources in its own business. And of course, if you are using somebody else's resources in your business, it is not going to come free of cost. You will have to pay a charge for that. For example, if I have to carry out my operations in this rented premises, I have to pay rent because this premises is not owned by me. I have taken it under a lease from someone else and I have to therefore pay a fixed rental every month. It creates a fixed operating charge on my business. This is an example of operating leverage. But right now, our point of discussion is not operating leverage, but financial leverage. When does financial leverage arise? When we are utilizing somebody's financial resources in our business in the form of capital. In simple words, when we borrow money or when we use debt as part of the capital, that is what we call as creating financial leverage. So the moment I borrow an amount at a fixed interest rate, I get a commitment to pay interest on timely basis, irrespective of whether I earn any operating profit or not. That is a financial leverage. So one side you get advantage of financial leverage, another side it comes with a risk as well, because the moment you are using borrowed funds in your business in some unwanted scenarios where you are not able to generate enough operating profit, not even that much profit that you could bear the interest cost, then you will have to drain off your equity for managing that debt. That is the biggest risk of having debt in your capital. Now, having debt in your capital makes the company a levered company. Correct? An unlevered company is a company that does not use debt in its capital. A levered company is a company that is using debt in its capital. The capital of the levered company is called a geared capital. Capital of unlevered company is called ungeared capital. These things, basic things, you would have learned at intermediate level already. So, what is going to be impact of financial leverage on your investment decision? That is what we are talking about. Imagine that I have to acquire an asset and I have sufficient funds available within the company in the form of past retained earnings, which represents one of the component belonging to the equity. So I may use that equity for acquiring this asset, or if the value of the asset, if the cost of the asset is rupees 10 lakhs, I may simply borrow rupees 10 lakhs to fund the acquisition of the asset. Now, generally what happens, cost of debt is substantially lower than cost of equity, correct? As a result, debt may be considered as a cheaper source of finance, and when I borrow money at a fixed interest charge, say just 10% per annum, and I am capable of generating income which is at a substantially higher rate, then what is happening? Somebody else's resources in the form of financial resources I am utilizing in my business at a fixed interest rate of 10%, but with that, what if I generate operating income of 25%, 30%? I will be getting that as an advantage. That advantage goes straight into the pocket of my equity. That advantage of financial leverage, when adjusted to the net present value of the asset, the adjusted present value arises. In other words, for computing adjusted present value, you need to do just two things. First, determine the net present value of the asset as if it was funded through equity, correct? That net present value you call as base NPV, and to that you adjust the effect of financial leverage. So base NPV plus the adjustment of effect of financial leverage will make the present value adjusted, and hence it is termed as adjusted present value. Now, in order to have a much clearer understanding, let us deal with a question in this regard, which will be a very good example for you to understand, and that will be from your book, question number 16. Let us read this question. A Limited requires to install a new machinery that will cost rupees 40 lakhs. This machine will have life of 5 years and its scrap value at the end of 5 years will be nil. For simplicity, depreciation can be considered on straight line basis. This machine can generate EBITDA, that is EBITDA, earnings before interest, tax, depreciation and amortization, of rupees 16 lakhs per annum. The tax rate is 30%. Company has two alternatives with respect to arranging the funds for acquisition of this new machine. First alternative is to employ the available retained earnings, and the second alternative is to raise a debt of rupees 40 lakhs which has applicable interest of 10% per annum, where interest is payable once at end of each year. This debt will be repaid by end of 5th year at par value. Let us look into what is informed further in the question. It says the applicable discounting rate for the company is 20% per annum. Now, applicable discounting rate is 20% per annum. What will be the NPV, that is net present value of this new machine under both the alternatives? Which both alternatives? Case 1, funded by retained earnings, which is given as unlevered case, and case 2, which is funded by debt, it is a levered case. What is the adjusted present value? How will you reconcile the net present value in the unlevered situation with the applicable adjusted present value? So at the later stage, the question is asking you for reconciliation between the NPV and the adjusted present value. So guys, let us do one thing. Let us first determine the NPV of the project if it is a completely unlevered situation, and what all has to be done in the solution with respect to adjusted present value, and how do you approach the calculation of adjusted present value because of presence of financial leverage. We will talk about this in detail as and when we are progressing with the solution. So if I take you ahead with the solution, the first part, very easy part, that is net present value of the machine for unlevered case, you can simply start with EBITDA. EBITDA is given as 16 lakhs, that is earnings before interest, tax, depreciation and amortization. So because it is earnings before interest, tax, depreciation and amortization, taxation will come only after interest, depreciation and amortizations are deducted out of this income that is available. So annual depreciation will be 8 lakhs. Now I don't have to tell you from where did we get 8 lakhs as annual depreciation. Cost of the new machine was 40 lakhs, its scrap value was given as 0 and the life was 5 years. So annual depreciation as per SLM comes to 8 lakhs. Because this is unlevered case where the company is using its own funds, not the debt fund, for this project there will be no interest outflow, correct? If it is unlevered case, there will be no interest outflow. What will be your annual profit before tax? It will be simply 8 lakhs. That is EBITDA minus depreciation. There is no interest outflow. And on this profit, you will be subject to tax at 30%. So profit after tax comes to 5,60,000. You add back the depreciation amount. Why? Because we want to compute the cash flows. So the annual cash flows after tax comes to 13,60,000. Now, you know there is zero scrap value and the cash flows every year will be constant. So what is the discounting rate applicable for the company in this given question? It is given as 20%, correct? If it is given as 20%, you apply 20% discounting rate and you compute the annuity factor at 20% for 5 years of its life. Guys, don't copy everything. Pick your calculator. Along with me, you also compute the applicable annuity factor. So what I do is I pick my calculator. I take 1 divided by 1.2, press equal to 5 times, 1, 2, 3, 4, 5. And once I get the calculation ready, I find the annuity factor that is applicable in this case is how much? 2.990612. I'm sure you also would have obtained the same annuity factor, okay? And multiplying the annual cash flows after tax to this annuity factor, the total PV of inflow what you are getting is 40,67,232. And what will be the PV of outflow? Basically, the initial investment required in this machine is 40 lakhs. So the net present value of this machine comes to rupees 67,232. So before I take you any further, please write up this entire calculation of NPV arising when the project is funded only by equity, that is retained earnings in this case. Please write up this working and then I take you ahead. Alright friends, once you have completed writing this entire calculation, carefully understand what we do next. Total present value of debt post-tax. Now this is always going to be an important calculation when you are dealing with adjusted present value. Whatever be the amount of annual interest that you pay, you know, from where did we get this 4 lakhs? If you are issuing debt for funding this project, you will be paying interest at the rate of 10% on 40 lakhs every year. So annual interest comes to 4 lakhs. But the moment you pay interest being a tax deductible expense, you will immediately have tax savings at 30% on that 4 lakhs. So logically, the real outflow from year 1 to 5 in the form of post-tax interest will be 2,80,000. Because it is annual outflow, the annuity factor at 20%, which we just computed few minutes back, you can apply that same annuity factor and the present value of cash flows towards post-tax interest will be 8,37,371. Thereafter, you have to go for repayment of this at 5th year end, that is repayment of 40 lakhs. Now understand one thing, there was tax saving arising over here, but with respect to repayment, there will be no tax implication because repayment is at par value. Suppose you are repaying your debt at a premium, then premium that you pay, on that premium you can save tax because the premium will become a tax deductible expense. Or if the debt is issued at a discount, or while issuing the debt, if you are incurring certain issue related expenses, what we can call as flotation cost, you may have tax savings on those components. But if the debt is issued at par and redeemed at par, on that repayment there cannot be any tax savings. As a result, the whole cash flow will remain as a cash outflow at the end of 5th year as it is. So we multiply that 40 lakhs to the 5th year PV factor, which is computed at 20%. Please check on your calculator, you are getting this PV factor as 0.401878 multiplied to 40 lakhs and you get this amount. When you take the aggregate of these two components, it is 24,44,881. Now guys, important thing, very, very important thing. Your debt is 40 lakhs. But you know, total PV of debt is just 24,44,881. This itself gives you indication that the amount that you have to consider as your liability will be the present value of outflows towards debt on post-tax basis. In other words, your cost of the asset is 40 lakhs. If you are funding it through equity, your outflow in terms of present value will be 40 lakhs. It won't change. But if you are funding the same asset through issuing a debt which has a nominal value of 40 lakhs, its real value today is the present value of outflows towards that debt on a post-tax basis, which is indicating the present value of outflow as 24,44,881. So don't you think that instead of having an outflow of 40 lakhs, it is better to have outflow of 24,44,881. It is going to substantially benefit you in terms of increasing the present value for your equity. That is what we call as adjustment on account of benefit of financial leverage, and that adjustment when you make to the base NPV, it is going to give you the adjusted present value. But let us not rush into that. Let us deal with this one by one. And first of all, let me give you two important concluding points over here. And those two concluding lines will be the present value of post-tax interest and the present value of principal repayment. The aggregate of these two is what we have obtained over here as 24,44,881. So my instruction is, don't just copy this note. Please understand and write it down systematically. Alright friends, once you have completed this entire working, let us move ahead and now we compute net benefit of financial leverage. Here we talk about the total PV of outflow. If it is an unlevered situation, entire 40 lakhs you will have to pay upfront utilizing your own 40 lakhs, your own funds over here. But if you are going with the levered option where you are using debt to finance this machine, your total outflow towards debt is going to be 24,44,881, which was aggregate of two components, the present value of post-tax interest and the present value of the amount to be repaid. Difference between these two will be the net benefit of financial leverage, and that comes to 15,55,119. So how would you compute adjusted present value? You start with the base NPV, which is the NPV arising when it is an unlevered situation. To this you add the net benefit of financial leverage, that is 15,55,119. Aggregate of this will give you adjusted present value. So please carefully understand one important thing before you write this working. Your NPV will be only 67,232 if you are going for unlevered funding, that is funding by your own funds or financing by your own funds in the form of retained earnings, and the NPV of the same project rises to 16,22,351 if you are going with the option of funding through debt. So please observe that the adjusted present value is substantially rising because of the net benefit of financial leverage. So please write up this entire calculation and then I'll show you alternative way of computing the adjusted present value. Alright friends, once you have completed writing this calculation, let me now give you a different kind of approach. Did you notice the heading? I am computing the total present value of debt as a pre-tax. That means I am not bringing tax implication in this calculation. So I'll take the annual interest of 4 lakhs, apply the annuity factor, and the present value of that debt, what comes to me, is 11,96,245 as the annuity factor applied on annual interest. In other words, this is the present value of the interest payments, and the repayment amount present value will be same what we got earlier. If I take aggregate of these, it will be the present value of debt computed on a pre-tax basis. So when you are dealing with an accounting angle, even in your accounting records, in financial instruments you would have learnt the present value of a liability. That time you don't take the post-tax amount, correct? You don't take the post-tax amount. You always take pre-tax amount. So your present value of debt without any tax adjustment would come to 28,03,755. Now tell me, what will be your annual tax savings because of interest? We have computed that earlier in the previous working. So annual interest tax shield, that is tax savings arising because of interest, we have computed that earlier. It will be basically 30% of this 4 lakhs, that comes to 1,20,000. And if you find the present value of interest tax shield, it will be the interest tax shield. I sure understand one thing, that you are clear with this point, right? Tax shield means tax savings. It could be because of depreciation, it could be because of amortization, it could be because of interest, anything. So here we are talking about interest tax shield. Every year it is going to be 1,20,000. You apply the annuity factor for 5 years with the same discounting rate 20%, and you get the present value of interest tax shield. So do one thing, before I give you the different angle of approaching the adjusted present value calculation, you please write up these two workings quickly. Alright friends, once you have completed these calculations, let us move ahead and find the advantage in PV of outflow. Cost of the project is 40 lakhs, but the total PV of loan, which is pre-tax, if you find the difference between these two, you get the net benefit in PV of outflow. And when you want to compute the adjusted present value, what you do is, you take the base case NPV, what we have computed earlier for unlevered situation. To that you add the net benefit in PV of outflow, what we computed over here, same amount. And apart from this, you don't forget that the present value of interest tax shield will be added to this, and you get the same adjusted present value which you got through the other way of making the calculation. So basically, in the previous approach, you have directly clubbed both of these, because the net benefit in PV of outflow, that itself we have computed on a post-tax basis. So we got the aggregate of this directly. But what happens, this alternative of calculation also you should understand. Otherwise, some textbooks you will be finding, some past examination questions you will be finding, where the solution provides these two calculations separately and not in an aggregate form. In such a case, you should not get confused. These two aggregate will always match with the post-tax calculation if you make it directly. Anyway, please write up this calculation quickly, and then I take you ahead with the reconciliation part as well. Alright friends, once you have completed this entire calculation, let me now show you something important. We can compute net present value under both the alternatives, and we can compare. It will give you a kind of reconciliation. Look at the calculation now. I have presented this calculation in double column, one with unlevered case, one with levered case. So in the first column, you are dealing with financing through your retained earnings. In the second column, you are dealing with the situation where you have used debt for financing this acquisition of machine. EBITDA and annual depreciation will be same in both cases. Interest will arise only in the second column, that is levered situation. So you see one thing, your profit reduces over here and you will be paying tax on the reduced profit, and that is where you save tax. Look at one thing, your tax would have been 2,40,000, but because of interest payments your tax is only 1,20,000. That is where we have talked about interest tax shield of 1,20,000 every year. So one component we have identified already over here. Profit after tax, it is 5,60,000 and 2,80,000. Difference between these two is nothing but the post-tax interest of 2,80,000. And how do we get post-tax interest? 4 lakh of interest minus the tax savings of 1,20,000. You will be getting the amount of post-tax interest as 2,80,000. Adding back the annual depreciation, you will be getting the annual cash flow after tax. You apply the annuity factor at 20% for 5 years and you will be getting the total PV of inflow under both the cases. When you subtract the PV of outflow, over here you will take 40 lakhs entirely. Over here you will take only and only the PV of outflow with respect to repayment of the loan or repayment of the debt. You should not take that aggregate what we computed, because the post-tax interest has already been subtracted before you applied the annuity factor. In other words, this cash flow after tax is already adjusted for the interest and the interest tax shield. So don't bring those elements again, otherwise there will be a double counting. And now when you observe NPV of both of these situations, you will be getting 67,232. In fact, the very first calculation we made in this solution was this particular column. So this is basically just the duplication. I have brought this column into picture only so that you can compare in contrast with what would happen if it is levered and unlevered, and you can see it is exactly these two amounts arising as NPV under both the situations. So please write up this working as well, and that will be end of the solution.